Good morning. Happy Friday to everyone. This is Traderfirstyear. This is a new trade. It's a 4/9/2021 new options position. It's a cyclical stock replication. You're going to be deep in the money, taking advantage of a fall in realized volatility and a slow market melt up in 2021. It's a cheap way to build a $65,000 portfolio through options with only $7,000. The TLDR, if you want to avoid the small print, the condensed version of the trade is pretty straightforward. It is long vol via long duration options and a long gamma profile. End goal is to make $4,000 in 6 months. There's a potential to make an unlimited amount of profits because you're taking a long position. Or the profit could happen before 6 months. Your total exposure is about $65,000. And again, it's built using $7,000 worth of capital. Okay, so volatility expectations. Markets are implying a move of 1.12% up or down on the S&P 500. Markets have realized a move of 0.92% up or down. The difference between what market makers are implying and what has been realized has tightened. The spread widened to 317 basis points. The VIX is expected to move 6.22%. The VIX is currently 1786. The VIX price range is 1897 to 1681. The put-call gamma imbalance has been reset, but is likely to favor more call buying. The S&P is expected to move close to 1.32% up or down this week, which means the S&P could rise as much as 14.5% or fall 11% above its 200-day moving average, which was 3,553.29. The S&P traded above its 50-day moving average of 3,887.97 last week. The market is currently pricing in an additional 5.74% move up or down by June 18th. The S&P could potentially trade as high as 4,235.20 and as low as 3,787.87 by June 18th. For the full year, by 12/31/2021, the market is currently pricing in a move of 12.33% from today's current pricing. The S&P could trade as high as 4,499, or if we round it up about 4,500, or as low as 3,565.65. This also assumes earnings of $175 per share, which equates to a 22.8 times price to earnings ratio, or a 4.3% yield, and an inflation adjusted on 5-year tips of 2.57% would equal about 1.73% yield for the S&P 500 at the end of the year based on those forecasts and those metrics. Full summary and rationale for the trade. The equity market from a historic metric is relatively expensive. Using market maker pricing and fall in expected realized volatility over the second quarter, traders could use options to cheaply replicate a 5-stock equity portfolio. Brief on the trading suggestion. Due to a fall in realized and implied volatility through April, May, and June, we will temporarily be in a period of reduced swings up or down. The current market environment is favorable for traders looking to sell convexity via short trade, straddles, strangles, call overriding, put rights, and other short vol strategies to capture alpha. It is also beneficial for traders looking to cheaply replicate long equity stock exposure through options by purchasing stocks with deltas of 0.80. These are deep in the money calls and have characteristics extremely similar to the underlying stock. They move exactly with the stock. It's obviously not a one-to-one movement, but it's a 0.8 movement with the stock. The rationale for the trade. Slow equity market melt-up is beneficial for deep in the money calls, which are a much cheaper way to express a long stock position. Risk for the trade. The risk is any large move down or over an extended period of time. Traders again are premium payers, so the largest risk is the option expiring worthless over the life of the trade. And if you look into the pricing, you can see this pricing was as of 8:30. And what I did is this is a cyclical trade, so I grabbed a financial, a metal, a mining, an industrial, an oil and gas, a consumer discretionary, and a technology stocks. Keep in mind that those are the cyclical sectors of the economy that are likely to benefit as we start a new economic cycle. And if you look at the information, you can see the strike. You can see that the strikes are deep in the money versus where the underlying price is. You can see the calls. You can see the cost. The total cost is about $7,145. The exposure that this gives you is about $64,000, so I rounded that up to $65,000. You can see the break even that you need over the course of the time period. And the expiration dates are 11/19 for the Bank of America call, 10/15 for the Nucor, and all the way on down. You can see all the way through that. So then the next question is preemptively answering a question about the upside on the trade. What if each individual stock rose 10% from its current price? How would the deep in the money options respond? What would be the price gain that you would receive? You obviously know if the stock fell, what the outcome would be. So the curiosity here is more so what is the price movement of the option based on a 10% move of the underlying stock. And if you scroll across, you can see to the far right what your profit would be and what the actual gain would be on the options price. So you have the potential on a 10% move for each of the underlyings to capture a overall 61.85% return, almost 62% return, in about $4,362. Again, they're calls, so the upside is unlimited, and this is just a good way to express a long equity position, and it's a cheap way to replicate the market without actually going out and purchasing the shares and using the options market to do it. Thanks for following, and thanks for listening.